Hi, welcome back to the channel, Bardia Fereidooni with Coldwell Banker. Today we are here with Sabina Adamski, Vice President of Mortgage Lending. Today we're going to go over most common questions home buyers and home sellers have. So if there's any questions that we do not cover, feel free to put it in the comments and we'll do a follow-up video and get back to you with an answer. Well, thanks for being here, Sabina.
Absolutely, pleasure is mine.
So let's say somebody wants to buy a home, first-time home buyer. What do they need in order to qualify for a loan?
That's a great question, Bardia, because purchasing a home is usually the biggest purchase that a person can make. So it's really important to talk to a lender early in the process rather than later. Typically, a buyer will submit their loan application and loan documents to the lender, where the lender will review. They'll go over the loan consultation with the client, they'll review their goals and see what makes sense for the client. So documents that are normal for a W-2 employee is W-2s, pay stubs, bank statements, asset statements. If somebody owns another home, we'll collect mortgage statements, any kind of liability documents. We take into account all factors. So we go over credit, income, and liabilities. Those are the main three. And then we see what makes sense for the buyer.
Okay, perfect. So how do you choose a lender?
Great question, Bardia, again. I always suggest to my clients that they treat the process, the whole pre-approval process, as a loan interview. So make sure that the person you're working with is somebody that you like working with, somebody who answers any and all questions that you have, and you know that they will confidently get the loan closed.
And that's something the Realtor can help by introducing.
Absolutely. Most of my clients come from Realtor referrals because a Realtor, typically, they're the ones who have a relationship with lenders. They're the ones who've experienced it maybe tens, 20, hundreds of times. They have a good relationship with that lender. Most first-time home buyers, or even someone who's owned maybe 2 or 3 homes, it's still a small number of experiences versus somebody who works day in and day out with their preferred lender. So typically a Realtor is an excellent choice to go for this recommendation. Any friends or family or anybody else who you know who's been through the process and had a great experience.
Okay, so say someone has their cousin or their best friend who has the license, who can do mortgages. What should they watch out for as far as making sure it closes?
Absolutely, great question again. So just because someone can do mortgages doesn't mean they should. Like any industry, there are people at the top level, and then there are people who don't put as much effort into their work. Work with somebody who you know that they're organized, they're efficient, they get things closed. See what they're doing in their life. Are they efficient? Are they getting things closed? Are they doing a ton of transactions? Are they organized? Are they dialed in? Because that's super important, especially in a market like this. You want to work with somebody who is on top of it and who's done this and who you can trust to get the job done.
And if they're not on top of it in today's market, how's that going to affect the escrow process? Yeah. You mentioned losing earnest money deposit.
Exactly. So, how you do anything is typically how you do everything. If somebody's dropping the ball and they're not answering your questions in the pre-approval process, how do you think it's going to go when you're in escrow? Do you think they're going to be over-communicating when they're in escrow all of a sudden, even though they weren't checking in on you during the pre-approval process, even though they weren't answering your questions promptly during the pre-approval process? Do you think it's going to go smoothly in the escrow process? Probably not. And there are a lot of things that can go wrong. So if your lender does not dot their I's, cross their T's properly, something can blow up. Anything can blow up. If they didn't calculate your income properly, if they didn't verify your income, if they didn't check for large deposits in your bank statements, and all of a sudden you can't use it, then that's an issue. And in California, you put money up. You put up earnest money, not just California, but all over. And whatever it is, whether it's 3% of $1 million purchase is $30,000. And for you to lose $30,000 just because your lender didn't dot their I's and cross their T's, that's a painful hit. So definitely just make sure you're confident in the lender's ability to close. Your Realtor will know because they have experience.
So before someone chooses between, should I use my family member, relative who does mortgages, they should know that 3% of a million, $30,000, that might be at risk. So maybe think twice before using friend versus a professional.
Totally. I'd say talk to the friend, 100% talk to the friend, see what the process is, treat it as an interview. Are they being prompt? Are they answering your questions? Are they organized? Are they giving you the information that you need?
Gotcha.
Are they calling your lender? Are they calling the listing agent on every offer you present? You really want to work with somebody who's going to put in the work to win your deal and win your offer.
Okay, perfect. What's the difference between pre-qualification and pre-approval?
Great question, Bardia. So a pre-qualification is basically just having a quick conversation with a lender where you tell them your income, your assets, your credit score, what you think it is, and then the lender basically not verifying any of that and issuing you a letter. A lot of people use this to get their foot into the door just to see a showing, and they're like, no, I'm working with a lender, and usually it's a starting point for them to start submitting their documents to the lender. It's 2022. So everybody knows they can go online, reach out to one of those internet lenders and get a pre-qualification letter. They input all of their information, anything that they want to write, they write, and then it's typically not verified. So it's not taken as seriously. There's much more weight placed on a pre-approval letter where the lender actually has a loan consultation with you. They review your loan application, they actually ask you questions in detail, and they verify the documents. They're going to request the bank statements, they're going to request the pay stubs, the W-2s, the tax returns, whatever relevant information that they need to verify in order to give you a loan. That's why it's taken a little bit more seriously in this market.
Okay, so the pre-qualification doesn't really mean much, especially in today's market. People should have pre-approval, and a good realtor, like myself, would make sure the clients have the pre-approval before submitting an offer.
That's right, and in this market, there's actually a new gold standard of pre-approval on top of the regular pre-approval.
Really?
So some lenders, they're ahead of the competition, and they're submitting a client's loan to the underwriter up front. So what they're doing is basically submitting a full loan application, all of the little documents that the underwriter will need, any kind of letters of explanation, just the full underwritten package. They're going to submit to the underwriter, and then when the underwriter approves it, they can waive a loan contingency. They can confidently know that nothing is going to go wrong in escrow, assuming they don't lose their job or whatever source of income that they receive. And at that point, once a client gets their offer accepted, we move to the process of they've already been approved. Now we're just underwriting the actual property. We're getting the appraisal, the title documents, if applicable, condo documents. The underwritten pre-approval is even better than a regular pre-approval because it's been reviewed by the underwriter. It's more than just the DU findings that a lot of listing agents might be asking for. It was actually reviewed by a human underwriter.
Okay, so that's going to give them competitive edge once they submit an offer in today's market, or really any other offer, have it underwritten too.
Exactly. That is what's making my clients stand out among other clients. So if somebody wasn't already reviewed by an underwriter, who do you think is going to stand out more to the seller? Somebody who was already approved, somebody that the seller knows is not going to fall out of escrow due to the loan.
That's a great point.
Right.
Wow, thanks for sharing that. Okay, and this is a question, it's kind of very broad. So if someone's wondering how much home can they afford, how can they find out? Like, what's the price I can afford?
Well, that is a very case-by-case scenario. So it's specific to the person and their financial picture and situation. So the best way to figure that out is to talk to a lender, and the lender will go over purchase price, monthly payment, and cash to close with the client.
So you can't tell the people watching individually how much they can afford? They gotta
That's right.
speak to a lender?
That's right.
Okay, so
we're not all that scary, so definitely talk to a lender, get yourself pre-approved, get the numbers, make sure you do that first so that you're not wasting your time in the process. You're not driving around looking at properties that are outside of your comfort range, or maybe you don't qualify, or maybe we need to put you on a plan to get you there.
How much does it cost for someone to find out how much they can afford?
Absolutely nothing. The pre-approval is free upfront. Nobody should be charging you anything upfront for a loan consultation.
Okay. How much should you save for down payment?
Great question. I think it's also individual to the person. It really depends on how much you're making. I think a good standard rule to follow in budgeting is to save at least 20% of your gross income. But for down payment purposes, a lot of people think that they need to put 20% down to qualify for a mortgage.
Right.
But that's actually a myth. And that myth comes from people's fears about paying private monthly mortgage insurance with their monthly payment. However, typically monthly mortgage insurance is not as scary as it seems. If you've got great credit, a low debt to income ratio, you're typically paying a very small nominal amount. Some people might even be paying less than $100 in monthly mortgage insurance. And on most loans, on any conventional loan, mortgage insurance usually drops once you reach at least 20% equity in the home. So as if you were already putting that 20% down. So once you get that balance, that is 80% of your value from when you purchase the home, the mortgage insurance can be removed. And at that point, you don't have to worry about that payment anymore. In Southern California, property values are rising steadily. Typically, if there's a refinance opportunity in the next year or two, I've had clients whose mortgage insurance has been removed through a refinance, or they call their servicer if there's no reason to refinance and they try to remove it. They'll order an appraisal, they'll remove it. But to get back to your original question of how much you need to put down, for an FHA mortgage, 3.5% down. For a conventional mortgage, anywhere between 3 and 5% down. So 3% down if you meet certain income qualification thresholds. If you're under 80% of the median income for the county, then at that point you can qualify for 3% down with a conventional mortgage. But typically you need at least 5% down for a conventional mortgage. And at that point you would be paying either monthly mortgage insurance or the lender can pay for it upfront in exchange for a little bit of a higher rate.
Okay, so we have all these different kinds of mortgages. How can someone know what's the right mortgage for them?
That's a great question. So again, I think it is a case-by-case scenario. So the best thing to do is to talk to a lender. There are several different types of mortgages. The most common is a 30-year fixed mortgage. A lot of people like to be in a 30-year fixed and have that fixed payment for the life of the loan. Right now, we're in a rapidly rising rate environment. So rates are going up. In the last 3 months, I'm quoting rates now about 1.5% higher in rate, which might be scary to some people, but there are other options. So for a lot of people who can see themselves either selling their home or refinancing their home within the next few years, whether it's 5 years or 7 years. I think there's a standard out there of, most people don't hold on to their mortgages more than 7 years. So right now in this rapidly rising rate environment, ARM products are becoming more popular. And an ARM is an adjustable rate mortgage. So a 7-year ARM would be fixed for 7 years. And then at that point, it would adjust every year. Depending on the terms of the loan, it would adjust either every year or every 6 months to a new rate. And then there are limitations and caps. It's just based on the market rate. And so it might be appealing to some people right now because the rate is lower than a 30-year fix. Typically, it's
for ARM.
An ARM.
Okay. So ARM rates right now is lower than 30-year fixed right now?
Yes,
okay.
Correct.
Just for 7 years?
No, there are several different ARMs actually. There's a 3-year ARM, there's a 5-year ARM, there's a 7-year ARM, even a 10-year or a 15-year ARM. And it's really specific to the client to see what their goals are. So some people are like, oh no, this is a starter home, we're gonna live here for 6 years. I would probably put them in a 7-year ARM. And then they'd get a lower rate and a lower payment versus the 30-year fix because they're either gonna sell, maybe even refinance prior to that. So it makes more sense for them to save money on their monthly mortgage payment versus paying the higher rate premium on a 30-year fixed when they might not hold that mortgage that long.
Interesting, okay. How do you lock in your interest rate?
Well, I always tell my clients that a interest rate is tied to a property. So typically, in order to lock an interest rate, you need to be in escrow on a property, or you need to already own the property. So in order to take a complete loan application, it is required to have a property address. At that point, you are able to lock in a rate. When a client typically gets pre-approved in the beginning, I'll usually give the client a rate range. As you know, rates change multiple times a day as they are subject to regular market fluctuations. It's tied to the 10-year treasury bond.
It's like the stock market going up and down. It's the same as interest rates?
Exactly that. So multiple times a day, lenders will reprice and different investors will reprice. So that's why it's tied to a property. The moment that they actually have a property address, at that point we can lock in a rate, and that will be their rate, and it will not change until any point.
So, and they do that once they go in escrow. Once their offer gets accepted, that's when they can lock in their interest rate?
Exactly. Okay. And then once the interest rate is locked, it will not change.
For how long?
Depending on the loan program. So we'll get you to closing. Typically the lock will last until at least closing to lock in your rate. If it's a 30-year fix, the rate will be locked for 30 years. If it's an ARM, it'll be locked for whatever the terms of the ARM are.
So if the escrow is in for 2 months, for example, or however long the escrow is, it's going to be locked?
It's going to be locked. We would lock you on a 60-day lock. So there's different prices and everything for the different lock terms, but you would absolutely be locked until the close of escrow. If you fall out of escrow, for some reason, you decide you don't want the home or whatever happens, anything can happen in this industry. But if you somehow fall out of escrow or decide to cancel, you would then lose that lock because it's tied to that property, it's tied to that loan application. Once you find a new property, we would lock in your rate based on that day's market.
So you can't transfer over the locked rate from a property to another property?
In most cases.
Gotcha. Something I've always had a question, and I'm sure many people have this question: what are mortgage points and why do they call them points?
Okay, so a point is technically a percent. 1 point is 1%. A half point is 0.5%. And sometimes there are points associated with a rate. And so sometimes when people are like, I want the lowest rate, I need to tell them that sometimes the lowest rate usually comes with the highest costs. And those costs are typically points. On any given day, there are various rates available. It's not just whatever somebody is quoting you. There's the rate below it, and the rate below that, and the rate below that, and the rate below that. And then there's the rate above that, and the rate above that, and the rate above that. So the rate that most people are quoted is called the par rate. And that comes with no lender points that they need to pay, and that comes with no lender credits that will be given to them at closing. Now, if the client wants to buy down the rate by paying points, they can do that. They can typically, most lenders have the availability to get you a lower rate, but you'll just have to pay the difference in price for it. If a client isn't as concerned about rate as they are with their down payment and closing costs, they might want a lender credit to be applied towards some of those title or escrow fees that they're going to be paying.
Right.
So then they would take a higher rate with a lender credit. But the rate that most people are advertised is the par rate.
Okay. And how can someone know, should they pay down the points or not?
Typically, making the decision to pay points or not is case by case, just like with a lot of these loan scenarios. But for most people, it doesn't really make sense to pay points because the break-even point to pay those points versus the savings that you'd receive for the lower rate would be several years down the line. And at that point, there might be an opportunity to refinance sooner. Typically, high inflationary periods like this are followed by recession-like periods. So I know a lot of the experts, Barry Habib, many experts are predicting a recession in the coming years because those typically follow high inflationary periods like this. So whether you think the rate is high now, there may be an opportunity to refinance in the near future, and paying points up front would be sunken costs at that point.
Okay.
No pun intended.
And where do you see the interest rates going from here? Some people are already saying, yeah, the rates are going high. Do you think they're going to stay around? What's the range right now? 4 and...
The range right now is definitely in the mid fours.
In the mid fours.
Low to mid fours, assuming, all perfect conditions, perfect FICO, perfect down payment amount, perfect everything. But the experts are predicting that rates will continue to rise. If you're paying attention to the Fed and what their plans are, they plan on raising the rate many times this year, their federal funds rate. So they're just trying to keep up with inflation, raise the rates, make sure people can make some money in the markets, but that also comes with higher interest rates for mortgages. Historically speaking, rates have only ever been under 4% 3 times in history, and the 2 most recent times were recently. People might think that the rate is high if they've never owned a home before, but if they've owned a home in the 90s or early 2000s, they know that the rate can be as high as 8 to 15% on a home loan. Yeah. So having rates in the 4s might be higher than the 3s and might be a little bit more uncomfortable for some, but it's still a great time to buy and start taking advantage of some of the rising appreciation that you can get by buying a home. So whether the rate's in the 4 or the 5s, it's still a great time to buy. There will always be an opportunity to refinance. Maybe not today, maybe not in 6 months, but eventually rates will drop again because they always do.
They always do.
They always go up and they always go down.
Yeah, it's funny. Yesterday we were speaking to someone after the open house, and he was saying he's one of the original homeowners who bought maybe in the 1960s or 70s.
Oh, wow.
And the interest rate was about 20%.
Right.
But the price of the house was about, how much was it, Mihao? Like 30,000?
Yeah, he said 30.
About 30,000. That same house that's worth probably over $1 million.
Exactly,
right now.
yeah.
That's crazy.
It is insane.
So speaking of refinance, I know a lot of people are refinancing right now. How does that work, and when should people refinance? What are the pros and cons? And
so there are many different reasons to refinance. Most people have refinanced in either 2020 or 2021 when the rates were at record lows. So it makes sense to refinance to get a better rate. You want a rate improvement of at least 0.25%. That's if you want to lower your monthly mortgage payment. Another reason to refinance is to change the terms. Maybe you've been in a 30-year fixed for about 7 years, but you're ready to get a 15-year fixed and you want to pay off your loan in 15 years, and you might get a better rate for that 15-year fixed. Right now, rates are a little bit higher, so we're not getting as many refinances to save money on their mortgage because the rates are higher and they would be paying a higher monthly amount. Other reasons to refinance are for cash out purposes. A lot of people want to take advantage of the added equity in their homes. Home values have risen over 20% year over year nationwide. So it makes sense to tap into that equity and maybe remodel your home, or maybe your kids are going to college, or maybe you just want some more money on hand because of the Fed's goal to keep increasing, the federal funds rate. And then, if you want to make some money in the markets, take some cash out of your house, it makes sense. But right now, that's what we're seeing: cash out refinances, or people who might want to remove mortgage insurance on their loan.
I see, that makes sense. Or go to Vegas and just blow it all.
Yeah,
why not?
Take all the money out of the house.
Yeah, perfect. So let's talk about adjustable and fixed rates. Why would someone want the uncertainty of having an adjustable rate where, what if the rates start to increase? But I know a lot of people do that. So why do they do that, and why should someone get either of these two choices, adjustable or fixed rate?
Oh, that's a great question. So right now we're in a rising rate environment, and rates are only predicted to continue to rise, at least for the next year. In that case, some people might be uncomfortable with the payment of a 30-year fixed because the rate is typically a lot higher than it would be on an ARM or an adjustable rate mortgage. So if somebody is only planning on being in the home for maybe 5 to 7 years or so, an ARM would make a lot of sense to them. If someone is probably predicting to refinance prior to that 5 or 7 year mark, a adjustable rate mortgage would make sense for them. Because the adjustable rate mortgage is a lower rate, their payment is typically about several $100s lower as well. So they want to take advantage of the short-term savings, it's definitely a short-term play for most people. They want to take advantage of the lower monthly payment, maybe invest in the stock market, or just have more money on hand month to month, and then they'll eventually refinance to a lower one, or they'll eventually move on and sell their home, and they don't even have to worry about paying the higher rate on a 30-year fixed.
Okay, so it's like someone who wants to live in the house more than 7 years, like 20, plans to have that house for a long time, 30-year would make sense. And an ARM or adjustable rate mortgage would be for a shorter play, right?
That's correct, but right now, most of the experts are predicting a recession, which usually does follow high inflationary periods like this. Mm-hmm. So at this point, if somebody is comfortable with an adjustable rate mortgage, I would absolutely suggest that they take it, because the experts are predicting at least recession-like conditions within the next couple of years. Maybe not in the next 6 months or so, but definitely within the next couple to a few years, there will be a refinance opportunity, because with recessions come lower rates like they did in 2020, where we saw record low numbers.
Gotcha. Okay, what's typically included in the monthly mortgage payment?
So the monthly mortgage payment is usually made up of the principal and interest, the taxes, and the insurance, if the buyer so chooses to include the taxes and insurance in the payment. In California, if a buyer puts at least 10.01% down, they have the option to waive the impound requirement for taxes and insurance. But otherwise, the all-in PITI, what you might hear often, is principal, interest, taxes, and insurance. That does not include any HOA fees. That's typically paid to the HOA itself. Separately. If the loan requires mortgage insurance, if they're putting less than 20% down or it's a requirement, then the mortgage insurance would also be included in that PITI.
Gotcha. What is the debt to income ratio, and why is that important?
The debt to income ratio is super important because it is the main factor in determining whether you qualify for a mortgage or not.
Really?
Yes. So most people who don't qualify, it's not typically due to the down payment. It's not typically due to the FICO. It is typically due to the debt to income ratio. And that's not to say that they don't qualify, but when I say they don't qualify, I mean they don't qualify for what they want to qualify for. So the debt to income ratio is just a simple math formula. You have your debts, all of your liabilities, your student loans, your credit cards, all of your monthly payments that you owe, divided by your monthly gross income amount.
Okay, so if you're an employee before taxes.
Before taxes, correct.
And what if you're self-employed?
For self-employed people, it's a little bit different because there are a lot of different income sources and expenses that come into play. So your lender will go ahead and determine that. They'll calculate your income based on, you know, the lending standards. They're a little bit different than the tax standards. They'll go ahead and use whatever income they can calculate from your tax returns to determine what your DTI is.
So you're saying all this math, should the person do it, or is the mortgage professional going to do it for them?
I think it's best for a mortgage professional to do it for them.
Yes. You guys are lucky out there. You don't have to do any math today. Okay, how quickly can we close a transaction? What is the usual number, and what is it today, and why is that important?
Okay, so before this crazy seller's market, people were closing loans in 30 to 60 days, and that was regular, standard. Now, to be competitive, you do need a close of escrow timeframe that is short and appealing to the seller. If they're getting some cash offers, usually cash offers are closing in 10 to 15 days. You want to work with a lender who can compete and close in 10 to 15 days.
And what can the mortgage professional do to close sooner? I know one thing you mentioned was doing the underwriting process sooner.
Yes.
Besides that, is there anything else they can do?
Well, talking to a lender early in the process is the best option because it gives you time to collect all the documents. It gives you time to submit the loan to the underwriter. It gives you time to get that approval so that once you are in escrow, things can move super fast so that we can deliver on those promises that we give to the seller.
So all these annoying realtors saying, speak to a lender, speak to a lender.
They're onto something.
They're onto something, huh?
Yeah,
okay.
They're definitely onto something.
You mentioned you regularly close jumbo and conventional, right?
Yes.
What's the main difference between the jumbo and conventional?
Oh, that's a great question. So a jumbo loan is any loan amount over $970,800 in Orange and LA counties, because in many other counties in the country, the conventional loan limit is $647,200 versus Orange County and LA County where it's $970,800. So any loan amount above those thresholds is considered a jumbo loan. And a jumbo loan has a lot more parameters that are at stake, and the jumbo loan investors have a lot more finicky guidelines to go through. So it is a little bit harder to qualify for a jumbo loan, but not impossible. Because the jumbo loan investors have more strict guidelines, it does sometimes take a little bit longer to close a jumbo loan. Some banks cannot close a jumbo loan in less than 30 days. At my company, we're doing same jumbo and conventional 15 days regularly.
15 days regularly?
Yes.
Okay. So for a multi-million-dollar mansion in Orange County, people, if they're going to finance, they would do jumbo loan.
Yes.
Right.
Yes. In Orange County, it's typical to see a lot of jumbo loans, especially in the Irvine area. But we also see a lot of conventional loan amounts as well.
For the lower priced homes.
For the lower priced homes, or some people who are buying, maybe a $2 million home, but they have $1.1 million to put down.
Difference between 50-year mortgages and 30 years. Why should someone consider 15 years versus 30 years?
If someone has the income to qualify for a 15-year mortgage, and the income needs to be there because a 15-year mortgage would be a much higher monthly payment, but the 15-year fixed usually comes with a lower rate than a 30-year fixed.
You save more money.
So you save more money in the long run. If you plan on, paying off your home in 15 years anyway, then the 15-year fixed would be more appealing to you because of the lower rate.
Gotcha. Okay, last question. What tips or suggestions do you have for someone who wants to buy a house within the next couple of years? They want to qualify and purchase something. What tips do you have for them?
Well, talk to a lender as early as possible is my number one tip.
Even if the income is not there?
Yes, 100%, because whether they want to purchase now or in 3 years, they still need a clear mortgage plan. They need to know how much they need to make. They need to know how much they need to save. They need to know what they need to do. So when I say as early as possible, it's never too early to talk to a mortgage advisor. So 100% talk to a mortgage advisor as early as possible.
And what would a typical plan look like? Is it getting the income higher for someone who wants to be a potential buyer in the future? Is it gathering the documents?
It's really a case-by-case situation because it's specific to the person and their finances. So depending on where their income level is now, and whether it's enough to qualify them for what they want now versus what they want in 3 years, it really is just dependent on, maybe they do need a higher paying job. Maybe they need to rise the ranks in their company a little bit. Maybe they need to save a little bit more money. Maybe I need to put them on a debt management plan and get rid of some of their debts. So sometimes these things take time, and that's why it's never too early to talk to a lender, to start talking about what you want to do and get a plan to get you there.
Okay. Should a self-employed or entrepreneur, small business owner, should they not deduct expenses in order to qualify for a bigger loan, or what are your thoughts on that?
My thoughts on that is that they should work with their CPA or tax professional to determine what the best scenario is for them based on their actual income and expenses. In the case of most self-employed borrowers, they usually like to deduct a lot of expenses, and then they're shocked that they cannot qualify for as much as they would like to. So I always tell them, you either win at loan time or you win at tax time. So depending on what your goals are is probably going to determine the route that they take and their tax professional takes in filing their taxes.
And the sooner they figure that out, the better?
Yes, always, in every scenario.
How much does it cost to figure that out?
It's free.
Woo!
A loan consultation is always free. You should never be paying for anything up front.
Okay, perfect.
Another tip I have for first-time homebuyers is to work with a great realtor and to work with a great lender, because I know that this market is scary. It's a seller's market. A lot of buyers are scared. What if it's not the market for me? I'm waiting for the market to crash. The market's not going to crash. It is a scary market. Home prices will continue to appreciate, maybe at a lower rate and a lower pace of appreciation, but they will continue to appreciate. So do not be afraid of entering the market, because if you're working with a great realtor like Bardia and a great lender like myself, then you will get into a home. You can rest assured that you will get into a home. There's no reason to be afraid of this market.
Write that down. Thank you for tuning in. I hope we answered your questions. If not, let us know and we'll get you the right answer. Make sure you subscribe, like or dislike the video, and we'll see you on the next video. Take care. Thank you, Sabina, the Vice President of
Mortgage lending with
Mortgage
guaranteed rate
Lending.
affinity.
Thank you.